Welcome to BNEWS Weekly Special Report. I'm Phil Gallagher, along with my guest today, Barry Sloane, President and CEO of Century Bank and Trust Company. Welcome to the program, Barry.
Thank you, Phil.
Barry is a graduate of Harvard University with a BA and a Master's in Public Administration. He's also not only is the chairman for, President and CEO for the last 15 years. He's also the chairman of the board of the Fisher Alzheimer's
Research Foundation.
Right. And also he's on the board of trustees for Mass General Hospital, amongst many other endeavors. And in his youth, he was a member of Hasty Pudding Theatricals.
Long time ago.
A long time ago. I presume you haven't kept up your membership there.
That's correct. They no longer need me.
Although as a CEO, sometimes acting qualities are necessary.
Indeed.
So you're in your 15th year as the president. Next year is your 50th anniversary of the firm.
Right.
Give us a snapshot of the origins of the company.
Of course.
How it came about.
Thank you. Nice to be here. So Century Bank will be 50 years old May the 1st. It was founded by my father, Marshall, who will be watching this show, so I'll be very careful what I say. He is 92, and he comes to the office every day and is still very engaged in virtually everything we do. My sister Linda is my partner in this, and so we are the largest family-controlled bank left in New England. We're just about $5 billion in assets, which makes us sort of number 5 in Massachusetts of the Massachusetts chartered banks. We're 28 branches now in metropolitan Boston, one here in Burlington, and for 40 years. I looked it up today on Cambridge Street, and so Burlington has been an important part of our growth as the bank branched. And we're in several key businesses. We are a community bank. We are now growing into a regional community bank. So our branches are very important. Our residential and small business lending activities, as you well know, we're very proud to have you with us for a long time, are extremely important core businesses. But we've also branched now into the largest lender, one of the largest lenders to education and healthcare in southern New England. So virtually all of our lending is in Massachusetts primarily and other parts of southern New England. So we stay close to home. Education and healthcare is critically important. Banking governmental entities is a big business of ours. We are the largest in Massachusetts, some 200 cities and towns bank with us. That's right, governmental banking. And what's called the lockbox processing business, for which we are now the largest in Massachusetts, Massachusetts-based, and process some 30 million items a year. So Century is a very diversified bank, conservatively run for a long time, with a strategic view towards the generations rather than the next quarter of performance. And as a result, we've had a terrific run. The last 9 years have been record growth of earnings, capital, loans, and assets. So we're very proud to be one of the success stories.
Well, let's go right to the core of that.
Yeah.
This is the 10th anniversary of Lehman Brothers failures, which actually was precipitated by the Bear Stearns, which they were counterparties apparently. Bear Stearns couldn't come up with the money. So your views on the causes and effects of the financial crisis of 2008.
And by the way, I might just make a recommendation for your viewers who would like to learn more about it. Is a wonderful movie called Too Big to Fail, which I highly recommend. It isn't altogether accurate, but it's close enough. But if you think back to 2008, 2009, that was an expansion. It was a bubble assisted by some rather fraudulent behavior, right? That people were buying mortgage-backed and commercial real estate-backed securities that simply were not what they were advertised, were not what they were intended to be. And when the world gets over-leveraged, particularly the investment banks that have a very different view of risk management than the commercial banks like us, then things snap. And indeed they did. And that was followed by a global liquidity crisis that could have brought the whole house down, the whole system down, but fortunately, that's why the movie's good to watch, the Treasury Department and the Fed linked arms together. The President Bush at the time gave them permission to inflate the liquidity in the system, to keep the remaining organizations healthy and alive, and we all lived through it. At the time, I know you've mentioned to me the TARP program, which was had to be approved by Congress, but was the Fed's attempt to inject capital into all of the stressed organizations, stressed banks and investment banks and industrial companies. Many will remember that both General Electric and AIG, the insurance company, were enormous beneficiaries of that. And that program's been entirely unwound, and to my knowledge, virtually all repaid. And much to many people's amazement, the government actually made money on it. We never participated in the TARP program for two reasons. One, we didn't need it. We were never meaningfully affected by that credit crisis.
Well, let me ask you this. I mean, you weren't affected because you didn't have toxic assets in the portfolio. Now, what was a toxic asset? Was it leaving old-time banking practices in terms of qualifications for home mortgages and business loans and things of that sort?
So several reasons. So virtually every loan we make, not everyone, but virtually everyone we make remains on our books, right, as a portfolio loan, be it a residential mortgage, a commercial loan, or an institutional loan to a university. And because we make those loans and hold them, we take a very different view of the credit quality and the risk management than an investment banker who's simply assembling packaged loans, selling them to a third party with no risk.
And wiping his hands of the
Right, the famous expression is no skin in the game. So that breeds enormous leverage, high leverage, one would say hyper leverage. And then when that happens, then people begin to cut all kinds of corners in their underwriting process. I mean, to give sort of the counterexample, I approve every loan in the bank. Every loan. I see every one. We do it every day. We call it the deal of the day. We might approve 20, 30 loans at one time. And my dad, my sister, and I, and the other senior lenders, we meet every Friday and do every large loan in the bank. So in the giant institutions, that would be laughable. In the giant institutions, it's done either by a sole signatory or a large committee, but that authority is dramatically dispersed, not only around industry authority, but around the world. So mistakes get made.
So you have one chink in the armor.
Right, and so one bad department or two or three. And as I mentioned earlier, in the credit crisis, there was the assembling of what came to be called toxic securities, largely built around residential mortgages and commercial mortgages, which were divided into tranches, into levels. And people thought they were buying a conservative level, and then they discovered when it was too late they actually had.
Backed by hard assets, which in
right,
fact were
but there was debt on debt on debt. The kinds of practices that we'd never consider. So with the sort of centralized, careful, conservative lending strategy that we have, the sorts of mistakes that were made by, I hate to just say Wall Street, but it's true, we never touched any of those.
Well, let's go back to TARP. Now, at the time, they're handing out money left and right, essentially. Now, during this period of time, I think it was 9 years, 10 years almost, every quarter you've increased assets, increased profitability, decreased leverage, et cetera. How was it you were able to, first of all, why didn't you take free money? Because you would have obviously increased your assets, subsequently your earnings, by reinvesting that money. Why didn't you take it?
Okay, well, first, because it wasn't free. There was a requirement, there was a coupon, there was a dividend you had to pay the government. And also the government then had some degree of control of the organization, of the issues of payment, the issues of growth. It was a very complicated agreement. As long as you prospered, they wouldn't interfere. But if you ever had a misstep, you could have members of the U.S. Treasury on your board. So lacking the need for it, we said, why begin the exercise? I don't think we missed anything. It was a period when rates were low. The use of that money was less so. So we made what we thought was a prudent judgment at the time. We don't regret it at all.
Well, how did you manage to increase profits when we think about within a year, Fed funds dropped to 25 basis points, 50 basis points. A bank of your size is investing depositors' money overnight. How did you increase profits making 25 basis points?
So if you think, what is the essence of a bank, right? It is managing the spread. between the return on your assets and the cost of your liabilities. If you have a high priority to liquidity and to short duration, short maturities, and higher than your peers, you're in all likelihood going to do better than your peers in the event of a credit crisis, which is exactly what happened for us. So we maintain, because of safety and soundness, because of our long-term view, because of our conservatism, which are the founding tenets of my father's view of business, we were able to readjust our balance sheet much more quickly than our peers. We were able to redeploy at lower rates, and we were able to maintain our yields and our net spread. So it was a complicated time, but for us it was not in any way a crisis for us at all. I mean, it was more, one had to be more resourceful because you were looking around wondering who goes next. And you have to think very carefully about the corporate partnerships you have, entities you traded with or entities you deposited with that all of a sudden could be subject to a crisis. But we were very careful. I mean, we run the business carefully. We work pretty hard. Banking is a business of temperament and routine. People who understand that you got to show up every day and open the vault. You have to keep a careful eye on the risks you take, on the customers that you deal with, and to make sure you have the long-term temperament, you're probably okay. People who fail in the banking business, and there have been many, tend not to have the right instincts. They ought to be in something else.
Right. And they're lending to their friends and other questions.
They could be, or picking industry concentrations. So to sort of fast forward now, what we worry about looking around is certainly the housing bubble, and in Massachusetts for sure, right? I mean, never have more units of apartments or condominiums been built in one period of time. We've seen, in many cases, double-digit increases in property values year after year, and that's wonderful for those families who were thrifty and bought a nice house 40 years ago, and now it's worth 5 times, 10 times what they ever dreamed it would be, and their retirement in many ways is secure, but one has to worry about all those assets pouring in. We make, I should say, many of our peers have made some assumptions that this march is going to go on forever. It's going to march to the sky. We don't share that. We, for example, as a bank, are not exposed in any meaningful way to speculative real estate construction.
Well, let's go back to one of the causes. Now, at the time, 10 years ago, you could put 5% down. You could get a first mortgage, and then you could finance the rest of your down payment with a second mortgage.
Yeah.
Have those type of lending practices been removed now from the housing?
Well, yes and no. So there's still a very vibrant first-time homebuyer program. And these are people who put down as little as 5%, in some cases with some government assistance, even 2%. And we've made a lot of those loans. And as long as these are people with good incomes and good credit, they've performed beautifully. I mean, we have never had a failure, to my knowledge, of one of those first-time homebuyer loans. At the same time, that's a very small slice, and what was happening 10 years ago is that practice was widespread. And there was also, as I'm sure you remember, there was a dramatic amount of fraud in the applications themselves, that people who did not qualify were getting qualified. The loans were not being made by banks. They were being made by mortgage brokers. They were being packaged and sold off to third-party investors. And then 2 years in, everybody realizes, particularly when they were adjustable rate loans, the rate would increase. They had no ability to service the debt, and they're in foreclosure.
And at the same time, we had utility prices going up, oil going up,
Right.
property taxes going up.
Right.
That burden added on to the increase in the
So there's a different housing bubble now than then. I would say that virtually all that fraud, it was long ago flushed out of the system with the improvements to the licensing, registration, and disclosure in the mortgage banking business. But there is now this assumption that home prices are going to go up every year in every community virtually in eastern Massachusetts. And many, if not most of my peers are financing the construction of rental apartments and condominiums really on the strength, in my view, of nothing but headlines. That they pick up the paper and they say, we need more of these, and we need lots of them. and everything's going to grow forever. And there's really no more substantive demographic research than that. And what we've learned is my father's learned in 4 or 5 business cycles in his time in the banking business that when the music stops, it stops suddenly. And those units that are incomplete or unsold, it's over. And then the banks spend the next 10 years working it out and writing it off. So we made a decision we want to be in other markets than speculative real estate, and we're very comfortable that we're not. Having said that, we have a big residential mortgage finance business, and it's remarkable. I think we have 1 foreclosure, thousands and thousands of loans on the books.
And the home equity business as well.
The home equity business is booming, and that's been wonderful because particularly for seniors who were worried about, they perhaps had paid off or virtually paid off their first mortgage. Now they just wanted to have some security, they wanted to have some cash flow, they wanted to help pay their children's education loans or buy their retirement place. They can use the equity in their home to do that. Interest rates are still, remarkably low, and they can only borrow what they need, and the debt service is small. And it's been a much more attractive and economical strategy than the reverse mortgage that we do not support. Fees in the reverse mortgage are far too high. Astronomical.
Well, let's go back a little bit. I've had this discussion a number of times with your father on Glass-Steagall. And then keeping in mind the regulation, talk about Dodd-Frank. What was Glass-Steagall, 1933?
Yeah. So Glass-Steagall was the separation of investment banking from commercial banking. And if you define the two, essentially, commercial banking is a deposit-taking entity where loans are made and the net spread determines your profitability between loans and deposits. Investment banking, on the other hand, is the Wall Street business. This is where trading, capital markets, mergers and acquisitions, and fees, not net spread, but fees determine the lion's share of the organization's revenues. And so, as I'm a commercial banker, so the skeptic in me says, we have a fundamentally different view of the world, right? As long as my clients do well and grow their assets, I do well. In the case of the investment banker, that's not always true. The investment banker needs to do a transaction, needs to do a deal to generate a fee. Whether or not that fee is in the best interest of their client
is irrelevant.
Well, I will say, there are plenty of good investment bankers, but
well, you have 10, 15 years experience on Wall Street.
I did my time, right? 19 years on the street in New York, so I've seen the good and the bad.
You're no stranger to it.
I've seen the good and the bad. So we have to keep that in mind, right? And now, okay, so that's the easy part of the discussion. Reimposing Glass-Steagall, why was Glass-Steagall repealed? It was repealed because most of the largest banks in the world were not American banks. That, for those of you who are as old as I am and can remember, in the 70s, I think the 3 largest banks were Japanese banks. And there was terror in the United States that we're going to become a second-rate financial power.
We had 16,000 banks.
Also true, but even the largest banks in the United States were numbers 5, 6, 7, 8. They weren't numbers 1, 2, and 3. And so
the biggest global deals were going to competitors.
Yes, they were, the Europeans and the Japanese. So now today it's all changed, right? So Glass-Steagall was unwound so that our U.S. banks could be universal banks, which is how they typically describe those banks from Japan, from Switzerland, from England that were not regulated insofar as the businesses they were in. So in that regard, it has accomplished what it set out to do, right? Because the largest bank in the world today, I believe, is J.P. Morgan. So, I mean, we are like numbers 1, 2, 3, and 4. And now what's happened differently now, the Chinese banks, the Japanese are not on the top 10 list. I think maybe 2 of them are. But now the Chinese banks are emerging instead.
But that didn't mean anything to Main Street, to your client, whether or not...
No, it didn't. It was a matter of global prestige and global financial clout. So lots of greedy people involved in that discussion, lots of lobbying people for their self-interest, as is our system. I mean, now if you take perspective, would I say that they should break up the giants into different pieces? I don't think it's as simple an answer anymore. You'd have to really give it some extraordinary academic and governmental study. And frankly, in the current political climate, I don't think that you'd never get a real debate going.
Okay, but let's look at the impact on the community bank.
Sure. Right.
We go back 10 years.
Yeah.
A de novo bank basically means a new bank.
Correct.
We've had
Newly chartered, right.
Newly chartered. We've had
Right.
a 10-year period
Yeah.
where we have virtually had not a single de novo bank in a decade.
I think there's only one application in Massachusetts. Okay, so a little context. In 1969, when Century Bank, when Dad got the charter, actually got it in 68, there were 36 de novo banks chartered in Massachusetts in the 60s and the 70s. We are the only one left. So all of those 35 others either failed, merged, or disappeared. So what's happened now is the banking industry in Massachusetts, and true for most of New England, is divided in half. The giants, the 6 giants or 5 giants, depending on the state, they control about half the deposits, and the regionals and the community banks control about the other half. Now, what has happened, to your point, is the independent regional banks, community banks, some larger than others, and typically a regional is $5 billion or above, and a community is, say, $3 billion and less. I mean, pick a number, it doesn't matter that much. But what's happened is, as you just pointed out, there are few, if any, smaller de novo banks or even small existing banks, say under $1 billion. And there are a lot of reasons for that, but the principal reason is it's just gotten too expensive because of
From a regulatory
Correct.
standpoint.
From regulatory compliance, from what is required now post-credit crisis, right, to run a business, to run a bank effectively. So to make a buck under, certainly under $500 million is very difficult. And it doesn't allow you to build the kind of reserves to weather any kind of a storm. So investors, when someone seeking a bank charter starts to ask investors, and I think the minimum these days is $20 million to even apply for a charter, you probably ought to have $40 million. People look and they say, you know what, there are better businesses. There's too much risk, too much regulation. And the current administration, as you know, was elected with the notion that they would reduce regulation dramatically. It has not happened to the smaller banks as yet in this administration.
Well, give us an idea of what you see on the regulatory side. How many people are in and out of your place of business on an annual basis on the regulatory side?
In terms of regulators?
Yes.
Oh, lots. So, we see virtually every year the FDIC, the State Department of Banks, the Federal Reserve. We have a securities business, as you know, so you can see the SEC, although not very often. But the prudential regulator, as the expression is, your principal regulator, that the word they use is prudential, is the FDIC. So we see them for one reason or another every year. And, I'm proud to say we're very well regarded because we work very hard at it. But, you spend millions in that exercise to have all the resources in terms of compliance, supervision, oversight, and the new phrase they have, which is enterprise risk management. This is sort of the magic totem. And when I was first made aware of it, they said, you need an enterprise risk manager. And I say, wait a minute, that's my job. That's what I get paid
That's
for.
Who I am.
My father was, had that job and still does, for 50 years. So no, we need you to create another enterprise that is parallel, that will write you a lot of memos every day. And I'm not trying to be, wise about it, because I understand it, I appreciate it. And if you look at the failure of those banks that do get into trouble, into crisis, it's because they over-concentrated and they did not properly diversify and they did not think about what were their risks. So as you load on layer and layer of this oversight, and this is true certainly in IT and in systems, with all the cyber risk, one must now have a whole cyber risk unit and then a secondary independent cyber risk unit to watch your cyber risk guys. And that doesn't include, our outside auditors and 4 other smaller outside auditors. So it's a big consumer of time and money, but that's the deal.
Are we safer now? Can it happen again?
Okay, so I would say the banking industry is safer from a structural point of view. However, a bank that still takes excessive risk, and now I will quote again the problem of the real estate bubble in a place like Massachusetts, is still subject to significant risk. So the customer needs to keep an eye on his bank. He should, every year, every bank must publish a counter statement, as it's called, certainly a publicly traded bank. You know, it's easy enough to look up and take a look at the stock price and take a look at the rating agencies. We're, I'm proud to say, straight A rated by Standard & Poor's, which is the highest rating a bank can have. There are only 15 of us in the United States, but that's very important to us. And people should keep an eye on credit ratings, on trends, right? As you mentioned earlier, we've had 9 years more or less of uninterrupted growth of assets, earnings, capital, et cetera. You need to watch those trends, which isn't to say that, you know, your deposit, an insured deposit isn't safe. It is, but you want to do business with somebody that you're sure has a solid future.
Now, let me give you a bit of a risk anecdote from years gone by.
Yes.
Your father had buttonholed Charlie Shea, who's a political luminary here,
Burlington
and asking for a deposit, and his mother's deposit. And Charlie went to his mother and said, well, you know, I'd like you to open up an account with Marshall. And Charlie's mother said, at the time you had the branch was on a trailer. And
that's correct.
Charlie's mother said that I couldn't possibly invest money in a bank that was on wheels.
Right, because I think the direct quote was, it might be gone in the morning with my money. So just so people understand, so we were building, Dad was building the first building of the bank. This would probably be 1969, probably 70. And there was a temporary office trailer on the sidewalk, literally, with the wheels on it, that was his office for probably 9 months or a year. So that is an accurate story. We did survive that crisis, and the Shea family was very, very kind to us.
Now, we've only got 2 minutes left, so I want to go to interest rates. The last 9 out of 10 recessions have been prefaced by an inversion of the yield curve.
Right.
Now, the yield curve right now between the 10 and the 30-year Treasury is somewhere in the order of 30 basis points.
Right.
Why is the Fed raising? Do they need to raise? Do they need more room, et cetera?
Okay, so I wouldn't panic, right? So the yield curve is flattening, but it's certainly not inverted as yet. I mean, if you look at the classic inverted yield curve, it's upside down. So we're certainly not upside down. And every recession is different. It is complicated to study the textbooks in the last one and say, here we go again, because everything is different. So far, I'm very happy with the Fed because, as we say, it's a quarter, right? They're going up a quarter every one of the 4 quarters of the year. That gives us plenty of time to adapt to it. People are beginning to see over 2% returns in their savings.
So if you're a fixed income maven, so the retiree, the elderly person who wants a CD is now getting returns.
So that should take some money out of the equity markets, which it has, right? We've given back, you know, 2/3 of the gain of the year. They worry a lot about inflation, not restraining inflation. They think there should be some inflation. I take a more conservative view on that. You know, inflation is the poison that eats through earnings of any kind of a company.
But their dual mandate is control of inflation and full employment. Aren't we there?
Well, we're close to full employment. I mean, depends who you ask, obviously, and depends where. But at 3x% unemployment rate, I mean, you're driving it almost as low theoretically as can be done.
Historic lows almost.
Exactly. And so the question is, as they raise rates to cool things off, they're also happy when they see a little inflation. That makes me nervous because, as you know, in the 70s, when inflation begins, it is a cycle. There's damn little you can do to pull it back. So, but I think Powell is a good man. I think he is thoughtful. He is very well trained. So far, we're happy with his strategy.
Give us 1 minute on your sense of the economic conditions going forward. Now
so in Massachusetts, we're speaking of?
Sure.
So look, education and healthcare is the core of our engine. The biotech expansion revolution is magical. This is a whole new industry that didn't exist 20 years ago. That's now employing hundreds of thousands of very talented people.
Cornerstone.
Right. So I would say it all looks good, right? So the risks are if the lower tier of educational institutions begin to contract because they have fewer students, because student debt simply gets to unsustainable levels. You could probably say it is already.
Sure.
Now, it's being offset by the increase in housing prices. That's what people are using these home equity loans for, to pay off the student debt. You know, so far so good, right? Because that's a huge generator of employment. And so if the current trends continue and we continue to have sound, careful government in Massachusetts, I suspect that we should be fine.
Great.
Yeah.
Unfortunately, we've run out of time. I'd like to thank my guest, Barry Sloane, who is the president and the CEO of Century Bank and Trust Company. Thank you, Barry. Thank you.
You're very welcome, Phil. Great to be here. Yeah.
Thank you for joining us.